It's Friday, December 20th. Welcome to This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. I'm Brian Walsh, and I'm joined by ImpactAlpha's editor, David Bank. Today, we'll be looking ahead to 2025 and the stories and trends we'll be covering, including It's the Ownership Economy, Stupid. Impact investors lean into economic populism. Climate gets a new narrative as Biden's policy tailwinds become headwinds in the Trump era. Institutional investors write ever larger checks for impact deals, but require catalytic capital to manage the risks. And finally, emerging markets attract local capital as well as outside capital as investors become more comfortable with the risk-return profile. That's all coming up on This Week in Impact. Hi, David. It's the home stretch before we say goodbye to 2024. How are you holding up?
Well, it's been quite a week. We do our look aheads to 2025, but it also means we look back on 2024 and what a year it's been.
Yes, looking ahead to the roundups that our team of reporters and editors have put together about the stories and trends that they're looking at. Overall, what stood out to you?
Well, this very, volatile, choppy, crossroads. I mean, all kinds of cliches come to the surface. But I think what comes through is that, the impact themes hold up no matter who is in office, and that good deals, good companies, good theses will prove out, and the fundamentals and the long-term trends are still in play. So keep your head on straight, eye on the prize, and North Star is impact.
All right, well, let's take these trend lines one by one. So let's start with impact investors leaning into economic populism and the ownership economy that we've been covering so much about. What do you see as the big stories we're going to be looking at on those beats in 2025?
Yeah, Brian, there's kind of a debate that's developed about whether what's underway, requires like a major shift in strategy, or whether it's really a repositioning or kind of a rebranding. And at the rebranding level, I think a lot of impact investors and fund managers are saying that the sorts of initiatives and investment theses that they've been pursuing, in fact, are aligned with a kind of economic populism, as you said, a sort of response to the kind of pocketbook or bread and butter issues that consumers and households are facing, whether that's affordable housing, whether that's small business starts as sort of many small entrepreneurs in particular that got started during the pandemic are now having their own businesses is their job actually, but things like that, home ownership obviously, and even things like making energy cheaper with cheap renewables, or making food more secure with regenerative agriculture techniques that are kind of climate resilient, are actually kind of on the agenda for any kind of sort of economic revival. And so that's the rebranding part. And then I think what the sort of more transformative part, as you said, is really this ownership economy that's really kind of taken hold or taken the imagination. And in particular, the one that has really gotten some legs is employee ownership. And because of the aging of the baby boom and the silver tsunami, as people say, of business owners who are looking to exit their business, there's a tremendous opportunity to share the wealth or share the ownership with employees. And there's an increasing number of mechanisms and funds and financing available to help manage that transition. And it's one of the rare win-wins or win-win-wins out there where, the aging out owner, gets an exit. The employees get a stake in the future of the company. The communities keep a valuable asset that's providing goods and services, and investors can even make a decent return. So those kinds of things, could stay strong and should stay strong in the year to come, and we'll be watching closely as this ownership economy takes hold.
All right, well, let's talk about climate and what are the stories and trend lines we're going to be looking at in 2025. I know, obviously, Biden had the Inflation Reduction Act that provided a lot of policy tailwinds for climate investment, and now with the new Trump administration coming back, we're going to see some reversals of that. But ultimately, you say there might be a new narrative when it comes to climate policy. What do you see about that?
Well, again, it's the question of what's required as a fundamental shift and what's required as a positioning. And our colleague Amy Cortese was at a deploy conference, a climate tech conference put on by the Department of Energy, and she made the observation there was very little discussion of the climate there. It was all green jobs and lower energy costs and beating China. And so there are fundamental drivers and fundamental advantages of much of the clean tech solutions that have nothing to do with fighting climate change, but which might just be sort of, as they say, better, cheaper, and faster on their own. And so again, entrepreneurs and investors who sort of keep their eye on what are the emerging technologies, what are the trends, what are the adoption trends, those things will remain true. The cost curves will still fall. Solar is still very cheap compared to legacy energy sources, and that will get only cheaper. I think that the pace of the adoption of many things will slow if there's no subsidies, involved. The subsidies, of course, might not go away as quick as people think. I mean, many of them are fueling jobs in red states, as everybody's pointing out, battery plants and EV manufacturing and that sort of thing. So again, eye on the prize. Where are the long term trends? Don't take the bait that somehow there's going to be an end to all the green and clean tech. That said, there's probably going to be a lot less, sort of, multi-billion dollar, loan guarantees from the Department of Energy's loans program office that have stood up or helped stand up some of the really big kind of decarbonization efforts. And, many of those things are going to have to stand on their own. Many of the founders say they can, and we'll see.
All right, let's switch gears now. And one of the big trends we've seen this year, and we expect will continue into 2025, is that institutional investors have been writing ever larger checks for impact deals, so more assets under management. But more of those deals are increasingly needing catalytic capital to help manage the downside risks. What are we looking for in these trends in 2025?
Yeah, we got a little cheeky when we looked at the new sizing of the market report from the Global Impact Investing Network this fall, and said it was 1.5 trillion ish, because the GIN had reported that impact investing assets under management had grown to 1.571 trillion, and I thought that was a little overly specific for something that was essentially an estimate. But I think that the directional idea that bigger institutional investors, pension funds, insurance funds are allocating more to impact seems to be true. We've been seeing that. I will say that much of that allocation is in the form of public equities, and there's a long-running debate, as you know, about the sort of efficacy of public equities investing for impact, in the sense that those are large liquid markets where your additional capital may not make that big a difference. However, people defend that and say, well, you could be a very highly engaged investor and have some influence at the board level or at the management level, especially if you're a big institution. So I think that folks are coming around to thinking that the pension funds and the sovereign wealth funds and the big family offices building out their impact portfolios is going to create a bit more of a constituency for impact on the cap tables. So I think that's all to the good.
And then where does the catalytic capital come into play? Because we're seeing that catalytic capital playing a bigger role in larger deals than previously had been the case.
Well, you're right, and it's twofold. One, the deals are getting larger, so the institutional impact investing checks are getting bigger, and at the same time, as you say, some of those checks, come with the requirement that they get some credit enhancement to essentially get the approval through the investment committees of those insurance companies, for example. The one we like, of course, is the SDG loan fund, where Allianz, the big German insurer, wanted to put $1 billion into small business lending to advance the sustainable development goals. And they enlisted first FMO, the Dutch Development Finance Institution, and then FMO and Allianz together enlisted the MacArthur Foundation. And there's sort of a stacking level of capital there that takes some of the first loss risk off Allianz and let, as I said, let them get their deal through their own approvals. But what's interesting is that they wanted to do that deal. They went looking for the catalytic partners that would help them get the kind of risk return profile that they needed.
So are you going to increasingly see the kind of growth of catalytic capital kind of going from innovative stage to maybe crossing the chasm to maybe getting to increasingly more mainstream adaptation?
Yeah, it's kind of like everybody can take on the risks and the returns of for their own appetite. And so another interesting deal was the Builder's Vision, which is Lucas Walton's family office, helping to defray some of the risk again in a debt for nature swap that was just done in the Bahamas. And basically, these kinds of things have been done. The Nature Conservancy has done about a half dozen of them, and essentially, sovereign debt, from countries, gets refinanced at a lower rate, and the savings get put into conservation projects like reef restoration or forest restoration, and these, again, kind of a win-win for both the country and for the environment, and even for investors who get to get out of these sometimes risky debt, countries with their sovereign debt, but in this case it was a private family office that helped again take off some of the risk for the commercial investors. And I think this was Standard Chartered that came in on this deal. And again, that shows that if you have the appetite for that, you can catalyze much bigger sums of money by being able to take on more risk, and so that's a good role for family offices.
And as we see more of these deals, more people become more comfortable, and it becomes a flywheel effect.
Well, that's the theory of the catalytic capital, in a nutshell, is that some of these risks are misperceived, and that as the track record gets established by doing a bunch of them, the commercial investors will see that it's not as risky as they thought, and they'll come in without the catalytic layer. So the catalytic investors should be working themselves out of a job.
All right. Well, speaking of misperception of risk, let's move on to our final story and trend we're going to be looking at in 2025, and that's emerging markets. That they're not only attracting outside capital as usual, as investors become more comfortable with the risk return profile of these areas, but also attracting local capital from local sources of wealth. So tell us more about that, David.
Yeah, well, the local goes two ways. One is, I think, a trend that did start in 2024, and that we'll be definitely watching closely in 2025, is institutional investors in, say, Africa, pension funds in Africa, now looking not just into sort of global, listed equities and the New York Stock Exchange and whatnot, but looking for local investment opportunities. And so local institutional capital for local needs, whether that's affordable housing, whether that's infrastructure, obviously climate, energy access, water sanitation, urban, mobility, charging stations, and all kinds of things that are needed to bring countries along. Those are excellent opportunities, and the local investors are increasingly waking up that they're sitting right there and they have a good view into that. And so that's one trend. And then the second local trend is local fund managers who have a closer view, again, proximity, as they say, to the needs and opportunities in different markets, getting allocations from global capital. So not managing these things from London or New York, but managing them in Nairobi or Lagos or Mumbai. And you painted a maybe slightly too rosy picture that folks are getting more comfortable with the risks, but maybe at the margins, I think some of these trends are looking positive. And our colleague Jessica Pothering thinks that this is something that will prove out over time, that you can get outperformance by going with both local and obviously diverse women and whatnot, fund managers, emerging first time, all things that were considered risky, as the data comes in, turn out again to be not as risky as folks thought. And there was kind of a signal event this year where a database called the GEMS database, which is the Global Emerging Markets database, and it's been kept kind of semi-secret for decades by the development finance institutions. It has like 15,000 transactions in it of all kinds, basically financing businesses. And lo and behold, when there was a kind of limited disclosure, after lots of sort of activism to try to free the data, again, risks were not as high as had been perceived. So as the world gets more datafied, the real risks get better known, and these growth markets around the world are going to be if you know how to invest it, if you're local, will turn out to be great opportunities.
Now, in emerging markets in 2024, Impact Alpha launched the LatAm newsletter and did a lot of coverage in the Latin American region. What should we be looking for in Impact Alpha's coverage of emerging markets next year?
Yeah, we really leaned in Latin America. We thought it was sort of the right mix of a growing and very exciting market that folks, in the North American and the European markets, in Asia, would like to know more about. And we had a great set of partners in the region, essentially, the kinds of networks of impact investors, Lat Impacto, New Ventures, Alterna, ProMujer, Impacto Capital, and others. And we've been just putting a sort of spotlight on Latin America. We have now a correspondent, Lucy Ngigi, in Nairobi. We have correspondents in Delhi and in India. So we are thinking that that's an area of growth for us. Again, it's sort of being something of a bridge between the fund managers and the impact managers, in country, and then our readers around the world, and hopefully letting some folks know about each other who might not have met previously.
And indeed, not only do we have more correspondents and reporters in more regions, but taking a step back about this podcast, this year we launched the Impact Alpha Podcast Network, and we look to continue to expand that next year. So we want to have different voices and perspectives, and have the ability to hear from smart professionals in the impact investing market, provide their unique perspectives, their diverse perspectives, and try to hear from the voices of the people who are the practitioners in the space. So we hope to be launching even more podcasts in the network, and highlighting these different voices.
It's super exciting. We've got, as you said, about a half dozen so far, and smart people saying smart things. It's going to only be more important as we go forward in the new year.
All right. So amidst all the turmoil and consternation and challenges that took place in 2024, there's a lot of reasons for optimism for 2025, even as we remain clear-eyed about the risks that we all face.
If you say so, Brian, I'm right there with you, and we'll be trying to keep our heads on straight and call it like we see it.
All right. Well, David, I look forward to chewing over all of those developments next year with you on this podcast. But for now, thank you so much for this episode, but also thank you for a great year of This Week in Impact.
Well, thank you, Brian, and thank you to all our listeners. And I hope everybody has a joyful and restful and happy holidays. And we'll see you next year.
All right. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha Podcast Network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next year for more impact.